this is probably one of the best opportunities to ask hard questions to the folks that help us capitalize our deals. So it's a really cool opportunity. Eric, you want to kick it off?
Let's do it. So first of all, thanks for having us, Sam. My name is Eric Pacifici, SMB attorney on Twitter, co-founder of SMB Law Group with a few of my fabulous colleagues here in the room. Excited to be with this panel of lenders today. I work closely and have closed deals with each of them. I tell all of my clients that getting your deal done requires experienced and competent lending. And SBA lenders, guys, to be honest, come in different shapes and sizes and competence. And there's really a very core group of sophisticated search lenders that I think each of you should work with. And we have 3 of them on the panel today. So excited to pick their brains. I would guess that between the 3 of them, you guys have done hundreds of panels, hundreds of podcasts and interviews. And so I would encourage the crowd to spice it up today. I think we get after them. I think we ask tough questions. I think we find out why we choose certain lenders over others. And I think we have fun with this. So I'll allow them to introduce themselves because I think they'll do a better job of it. But we have Bruce Marks of First Bank of the Lake, Matt Dolsky of Byline, and Lisa Forrest of Live Oak. Starting with Lisa, if you want to give a quick introduction and your background.
Sure. Hi, I'm Lisa Forrest with Live Oak. So happy to be here. I was at Bash 1, and it's amazing to see how it's sort of morphed and matured, and it's just starting. ETA has just exploded over the years, and it's just, I got a question yesterday, hey, do you think that we're at the peak? No, we're not even at the starting point, really. I think the car isn't even turned on quite yet. So it's fantastic to see. This is starting my 37th year of SBA lending. And at Live Oak, we also do conventional lending for traditionally funded searchers. Nearest and dearest to my heart is the SBA program for our self-funded searchers. So I'm glad to be here and happy to be up here with my friends as well.
My name is Matt Dolsky, and I'm with Byline Bank. I manage our self-funded search and M&A vertical. I've been with the bank, it'll be 10 years next month that I came back. I worked with them as an analyst and then came back about 10 years ago and have been doing SBA 7A lending and companion conventional lending ever since then. 5 years ago, I didn't even know what a search deal was. I think I accidentally stumbled into my first one, and now fast forward, 5 years from now, it's all I do, and we're building a team. I'm excited. I have a junior lender that's starting on Monday, which will be nice to take some stuff off my plate. So I'm just really excited to be here and talk all things search.
Good morning. I'm Bruce Marks with First Bank of the Lake. Like Lisa, been working in SBA. I made my first SBA loan in 1986, so a long time ago. I've closed well over 1,200 SBA loans during my career. I made my first search fund transaction in 2015 when a gentleman from Harvard introduced me to the program and fell in love with the model and have done nothing since then. So I strictly work with searchers. I've closed $360 million in the space over those past 8 years. So a very robust pipeline exists. We're happy to support the folks that are here today and looking forward to providing value and helping in any way I can.
All right, let's start with a softball, guys. Let's talk about process. How do prospective buyers find you? What do you guys like? What do you dislike? How does your bank differ from other financial institutions? Give us the sales pitch.
Want me to
start with Bruce?
Okay. Yeah, so, searchers typically will want 2 things, certainty to close and speed, right? That's what you hear. And then they throw in, well, what's your interest rate? Certainty to close is something that I'm very proud to talk about. At First Bank of the Lake, I head up our M&A vertical. And basically, when I was brought on, I worked for a private equity group prior to that for 5 years. We built the bank, we grew it, and we sold it. So we had our exit. I joined First Bank of the Lake. And when I first joined them, I was very clear with our executive loan committee that they needed to understand that it basically was my decision and they needed to support my decision, because I convinced them that the deals that they are going to be seeing are the deals that I think they should be seeing. And if it's not a deal that I think that they should see, then they're not going to see it. So I take responsibility for that. So they've empowered me to make the decisions at First Bank of the Lake. We're a little bit different. I do not run up through credit like most lenders do. I have my own closing team, I have my own legal team, and I have my own underwriter. So what I like to tell searchers is if I look you in the eye and I tell you I'm going to get your deal done, that is in fact what happens. And I want to provide that certainty to the searchers. Everybody has choices. There's two great choices, obviously, to my right. But I want to make sure that I am delivering and meeting your expectations and providing those. That is the thing that is most important to you is getting your deal to the closing table.
And real quick, Bruce, how do searchers find you? How do they get into your process? How do they start working with you?
So most of the searchers find me through either Search Funder or Twitter or other folks that I've helped, LinkedIn, just all the various different social media. We don't have a tremendous outreach at First Bank of the Lake. We don't have a huge marketing budget. Like this was a major thing for me to get money to sponsor this. Like that was like a really big thing. And I'm thrilled that we did it. But we're not a big bank. We're a small bank. And I think it's just reputation and being able to deliver. And I think that's how people find me.
Okay. You talk about part of your question was process and part of it was differentiation. I think one of the things that's important is all three of the folks that are up here, Bruce and Lisa and myself, our banks support the search community through, we all have a specialty in self-funded and traditional search. We all call it maybe, different things, sponsor finance or self-funded search and M&A. But to my knowledge, we are the only three banks in the country whose banks have said we are going to dedicate an entire vertical to this space. And what that means, you could say, okay, Matt, well, who really cares about that? That, give yourself a fancy title and big deal. But what that means for the searcher is that the bank understands what a typical search profile deal looks like. You'd be surprised at how many banks are not comfortable with $5 million plus airball loans, or are not comfortable with 90% of the equity injection in a deal coming from investors. Now, for all of us here, that's just kind of commonplace. That's like what we see in the deals that we look at and the stuff that you guys and gals are chasing down out in the marketplace. But not every lender, and in fact, I would venture to say most lenders are going to look at you cross-eyed when you start talking to them about those kind of deals. So I think anyone, I don't want to, pat myself on the back, but Bruce, Lisa, great people to work with, great banks behind them. And I think that's what probably, differentiates myself at Byline, but also the other folks that are up here.
Yeah, that's an excellent point. And for those of you, there's plenty of debt out there. That's even with rising interest rate, there's still a lot of debt out there, and that's good for the M&A community. It's about finding the right fit, and for us, our confidence to close super important for all you in the room. And because we have dedicated verticals within our banks, that's really important. So as you're talking to other lenders, kind of sniff around and find out, how they do make their decisions. Who do they have to work with? Mm-hmm. And to Bruce's point, we have dedicated underwriters, analysts, closers that do just search deals. And that's important, especially when you have investors on your deals and you have these kind of funky SBA forms your investors have to sign. You want to work with lenders that are walking you through that process right up front. And I think the other thing that all three of us probably have more in common than we don't is we're here to coach and mentor you, especially for the first-time buyers. We have cash flow templates, we have executive summary templates, we have a lot of deal vetting resources for you. personally for me, it's an important what I think for sure, right? You're coming to us for our opinion, but for me, in my process, I want to know what you think. I want to help you get to your point of view as kind of quickly as possible. It's important that you are listening to your deal team. That also includes your lenders, your attorneys, your CPAs, but you need to have your own voice and you need to understand what your point of view is so that you can coalesce all of the professionals that you're going to have on your deal team. And especially when you're talking with the seller, it's really important you understand what your point of view is, because that gives you the ability to decide to compromise or not to compromise. It is really helpful in your negotiation with your lender, with your deal team, with the sellers, when you really truly understand what you think. And it takes time. It takes time. And so just personally for me, and I know Bruce and Matt are the same way in their interaction with you, it's a relationship. It's a relationship. And I want you to get to your point of view so that we can have a really good, robust conversation over what might be a whole year before you find a company to buy.
Oh yeah.
Yeah, just to piggyback off that, if I could, the about getting in touch and how to work with us. I know for myself, I have heard other lenders that are even colleagues of mine at Byline that they don't want to talk to a borrower until they have an LOI, and I think that is just the completely wrong way to go about interacting and working and building a relationship. Just like you mentioned, I mean, I've had folks that I've worked with for 12 to 18 months and looked at 15 different deals, and
Yep.
we're talking about cash flow and structure, because when you get to the point of an LOI, if in my opinion, if you haven't kind of vetted that out with your SBA lender, you may have provisions that they're agreeing to the seller, that you're getting the seller and you're negotiating and you come to this agreement, and then you bring it to the lender and it's like, well, that's not going to work.
Right.
That's not even SBA eligible. So I think it's important, no matter who you're talking to, start having those conversations early. Most of us, and I know everyone up here is more than happy to have those upfront conversations and talk about structuring and cash flow and what industries and all that kind of stuff. So I think it's always good to start that earlier rather than later.
Yeah, and I'll just piggyback on that real quick, Eric. You know, do a lot of one-on-one calls, obviously, and searchers will always ask me, well, what's your process? When do we bring you in on the deal? That's a very common question. I think all three of us would echo the same comments. This is about you. It's not about us, right? This is about getting your deal to the closing table. You bring us in when you want. There's a gentleman out here today, his name is Nick. And when Nick first got involved in his transaction, he reached out to me. We started having initial conversations. He says, I really want to buy this business. I'm well versed in the business I want to buy, but I don't know anything about the lending process. And it started from, well, do you want to submit an LOI? Well, what does that look like? Where can I get, a template for that? So it starts at that. This is about you guys, right? So it's about everybody else out in the audience. And I know every one of us up here would echo the same, that when you're ready, reach out, whatever point that is, you determine when that is.
Mm-hmm.
But drill down on that for us guys, though, and be concrete, because we're all very busy, right? And there is a lot of searchers and there's a lot of tire kickers. And our time as service providers is limited. What is really the best way for these guys to get your attention pre-LOI and actually get that advice? How do we present ourselves in a manner where you guys are going to look at this searcher versus that searcher and say, this guy is serious, and so I'm actually going to devote the time to helping them?
To Matt's point, I'm sure, and I know all of us have worked with a searcher for a year, 12, 14 months, 18 months. I can give you everybody knows I love stories, right? So I can tell stories after stories of beginning with a searcher, Eric, and we finally get the fourth deal to the closing table after 16 months. So I don't make a determination at the beginning at all whether this is the right person to work with or the wrong person, because generally they're looking at deals, and maybe that deal ultimately, for some reason, doesn't make it to the table, or they break up, or they submit an LOI and they're doing the Q of E and the numbers don't flush out and all that. So I think most importantly, I I'm not judgmental of when or who, because ultimately I have closed deals where it's, hey, this is the fourth deal that we've looked at, and we finally get the deal to the closing table 16 months later.
Yeah, I would. Oh, sorry.
Go ahead.
I was just going to say, when you talk about, like, getting attention and kind of being a real buyer up front, one of the things that I see sometimes, which blows me away, because I can guarantee you that every single one of you out in the audience is smarter than me, but every once in a while you'll have somebody who comes to you and is like, hey, take a look at this deal, but you can tell based on what they're presenting to you and what they're talking about, they haven't even really thought through what the cash flows, what the add backs are, anything about structure, and they're kind of just completely leaning on me to kind of take this blank canvas and paint it. And to me, that's not really the right way to do it. I think, as a searcher, you should have some idea of, okay, this is why I love this business. This is what I like about the cash flow. This is what I like about the industry. This is how my experience kind of fits into it. And sometimes you just get a sense that, like, somebody just got a sim or a teaser from a broker, and then they immediately call the lender, and it's like, well, here it is. Let's like talk about it. And I'm like, okay, well, tell me. And it's like, well, I don't know. Can you take a look at the sim and then we'll go through it? Now, I'm not saying that I'm going to hang the phone up on that person, but I just think that if you really want to, get the attention and be the squeaky wheel, so to speak, that, it's good to kind of have some idea of how you're looking at the deal, because that matters to me.
So we talk to thousands of people every year, and it's not a character flaw that you might have to go through 4 pre-LOIs to find an LOI. We get it. That's the gig. We totally understand that. In order for us to help you, you have to be a certain level of prepared, because look around. This is just a tip of the iceberg about how many people we probably talk to on a weekly basis or a monthly basis. So what my lending partner, Heather Anderson, and I finally did is we put an office hours together. Every Wednesday, we have people join us, and we just talk kind of SBA 101 first. And then we have a Thursday call where we share our cash flow model with you, and we share executive summary templates with you. So that when you want to vet deals with us, and we are very happy to have you do that, we want your point of view first. This is talking about what Matt's getting here to and what I spoke about earlier. I want to know what you think. Don't just send me the sim. Don't do that. That's not fair. I don't have time to, nor do any of us have time to look at 50 pages. If you are searching full time, you got time to look through the 50 pages. Mm-hmm. And we give you a simple executive summary template so that you can give us an overview of, certain salient points. And, you get better at it as you go. So the first one is probably, you're going to forget to tell us about customer concentrations.
That's right.
So noted. That you just get better at it as you go along. So have a process, and then we're happy to chat with you.
Okay, we've got 15 minutes left, so I'm going to speed this up. And
we haven't even argued yet.
We have, so we're gonna just dive right into the meat of it, guys. Let's talk about interest rates. They're rising. It's creating complications in deals. Debt coverage service ratios are, obviously more difficult to achieve.
Yeah.
Talk about it. What do we need to know, first of all, about shopping for interest rates, the reality of it, and what are rising interest rates doing to the SBA lending market? Bruce.
Yeah, so Lisa and I were talking about this last night. It's obviously tougher for a deal to pencil out with much higher rates. I remember looking at a deal, $5 million deal a couple of years ago. Your payments were $54,000 a month. Now they're $66,000, right? So that's basically your salary. For a typical searcher, it's $150,000, right? So now you have to pencil that deal out. I think I'd like to just share a quick story with you because I think it will resonate. I was approached by a searcher back in October of 2021. He had a transaction under LOI. As he told me, he found me 8th in the game. I was the 8th lender he spoke to. But he had a Q of E for 10 months. So he was looking to buy this business for $5,250,000 on a 10-month Q of E. There was no cash flow for 20, There was no cash flow for 19. He had a 10-month QOV in 20. And he said, if I wait till the end of 21 to get this deal done, it's going to be higher. And I said to him, I'll get your deal done. So the deal penciled out. It didn't pencil out at 1.5. It didn't pencil out at 1.4. But based upon what the business was going to be able to do, and what we said was, we'll get it approved subject to 2021 numbers flushing out to make sure that the debt service was at least 1.3 times. Today, that business is doing phenomenal. He's grown it. The point is yes, interest rates are rising and it's making the deals tougher to get done. But my philosophy is as the searcher, it's what you bring to the table, what you can do with the business, and more so how the business is going to look 6 months from now when it's under your control versus what it looked like 6 months prior when you weren't running there. So yes, interest rates are rising. Yes, it's tougher to get deals done, but I'm okay if I've got 1.3 times cash flow coverage and I'm relying on you, and I know that you are the right jockey on the horse that's going to be able to take that business. And I would tell you that Lisa and I had talked about deals and transactions that maybe were struggling, deals that maybe, you look back the way you've lent and the process in which you do it. And I can tell you that because all the searchers ask, how's your portfolio doing? Are they in trouble? How many deals go bad? Do I have to worry about the person? All those kind of things which we can have conversations on. But I can tell you that we're doing it right because all the searchers that I'm working with and have closed on are doing really, really well. So yes, it's definitely tougher to pencil out deals as rising interest rates. But to Lisa's point, your experience, what you're going to do with it, how you're going to make it your own is super, super important for me when I'm making that decision.
I guess I would say when people ask me about interest rates, the first thing I say is ugly. That's what they are. They're really ugly. Plan between 10 and 11%, because we still might get, another 25 or 50 basis points, or who knows what it'll be. I think it does present an opportunity as well. An opportunity in order to model your deals based on 11% interest rates. And then the converse of what Bruce was talking about is going to happen, where you're going to model it after that $65,000 payment. And there's probably some reasonable likelihood that 5 years from now, that 65,000 is going to be 55 and not the other way around. And I would certainly rather be the guy or gal that does it, models it with that $65,000 payment at an 11% interest rate. And then, at maybe some point, prevailing, SBA loan interest rates will be 5 or 6% again. You're going to be really happy if you modeled everything out at 11. So I think, is it good, for buyers that you have high interest rates when it seems like businesses are still trading, that the price hasn't really come down in conjunction with the rising interest rates? At least that's my read on it so far. But I still think there's opportunities in how you look at it that can position you for success in the future.
Maybe it's just that I'm old, which I am, but a 8, 9, 10, 11% interest rate, that's actually stabilized, certainly around 8, 9, 10, doing loans as long as I have. This is not crazy. 3% is crazy. So, so I think for sellers that they are in shock. They've just come out of their best 2022 ever, and now their company is worth less, not worthless, but it is worth less because of you, as their buyer said, if you're getting an SBA loan, you are now at a cost of capital that the seller is just not digesting yet. They're starting to. My prediction is that in the next 6 months, hopefully in 6 months, valuations will be a lot more affordable for our lower middle market SBA type acquirers. But, we are modeling a little bit more like 11 for a kind of a test because we think that there's still a little bit more room for that. But I think interest rates are going to be here at this level for a while. They will come back down again, but hopefully not to the level that they were over the last couple 2-3 years, because then you've got really huge disconnects in your economy. So I am unapologetically the more conservative lender on this couch, and we want a 1.5 debt service coverage in the last full year. That has been my lending standard for decades now. And so for what we're seeing, there are obviously fewer deals that are going to work at my 1.5 than at a 1.25 or some lesser amount. It's all about the fit. Being with certain lenders that have certain criteria, it's all about finding the right fit. If we're saying no to a transaction, it doesn't necessarily mean that it's not a good transaction. It could be a great transaction for you. We've just got a certain risk profile that we are looking for. And I'll say, just be patient and be disciplined. The last thing you want to do is buy a company that maybe only debt services in the last full year by like 200%, and it's never debt cash flowed in any of the other years at all. I mean, you really got to, in my heart of hearts, you got to stay disciplined, because the deals will come. I know it's easy for me to say, but I actually own my own small business, by the way. I've had an SBA loan. I've done the whole deal before, and I've got an enduringly profitable company. And you just have to be patient and stick to your point of view. That's also why I suggested earlier, know your point of view. And it doesn't necessarily mean it's any of your deal team's point of view, but stick to your point of view and stay disciplined around it.
And guys, in just one word, are you seeing more or less deals right now than you were seeing at this time last year?
As far as deal flow? Oh, there's tons of deals. Plenty of deal flow. Deal flow ain't the problem.
So it hasn't slowed the market.
No, the deal flow is there. The sellers are there. It's just, is the deal affordable? Is it doable? Customer concentration, all the qualitative stuff, customer concentrations, dependencies on the seller. How is the sale actually generated? Who's doing what in the company? There's so much that goes on in lower middle market. So deal flow is plentiful.
Yeah, I would say deal flow is way more robust. And I think that's expected, right? You've got a lot of schools now introducing ETA, right? You've got the knowledge just on Twitter, right? Like, so, and the social medias of the world that are advertising. When I went to school, it was get married and buy a house. Today, it's, don't get married, and if you do, don't have your wife take your last name, and, buy a business, right? So it's totally different, right? Like, it's amazing to me. I don't know, because I'm old school, and this is my wife, and she's got a last name. I'm like, what? But just sidebar. But I think from my perspective, deal flow is just tremendous. The space is growing. To your point, you said it's just beginning. So there's a lot of people out there searching to buy a business, and that gives competition to the folks out there. But there's a lot of good deals, and as Clint pointed out, there's a ton of deals in that small, tiny space, the 30,000, 300,000, businesses for sale that maybe won't sell. But yeah, for me, deal flow is super robust.
Agreed.
Awesome. Just reading the Twitter comments, they have questions for you guys, but we'll hold those for the end.
We're already out on Twitter?
We're out on Twitter.
Oh,
we're
man,
live.
okay.
We're not talking, we're not revealing what you guys are saying, so feel free to be candid though. Banking meltdown, right? We've got a financial system in turmoil. Be honest with us. What are you guys seeing behind closed doors? It seems to me that it's reasonable for all of us to expect that every single financial institution right now, community bank, is concerned. What are you guys seeing on the other side of the veil? Be honest with us.
Yeah.
Matt, you can go first.
Yeah, I can take that one because I'll be pretty quick with it. I haven't seen that it's affected anything, and shortly after it happened, I called our president and said, "Hey, tell me what's going on." And we looked at some deposit outflows and inflows. I think it hasn't affected our lending. And I would venture to say probably, everyone up here and most SBA lenders didn't have deposits in cryptocurrency or, significant deposits to, a bunch of venture capitalists or something. So I have not seen where it is affected the way we're going to lend or anything that would relate to self-funded search or the health of the bank in any way whatsoever.
Agreed.
Yeah,
It's a short topic.
Yeah, I we're a small bank, but we had that conversation obviously after SVB went down. Our portfolio is filled with SBA guaranteed loans. That's what we do. We do a conventional, we do the pari passu, but it's in conjunction with SBA. So we only do, USDA, SBA, anything that's government backed. So our portfolio is very clean as a result. So yeah, to echo those comments, we haven't seen, it hasn't impacted us at all.
Okay, we believe you. Best buyers, worst buyers, guys. What are the characteristics of buyers that you see and you go, this is almost certainly going to be a yes for me, assuming the deal pencils out, and buyers that you see and you go, I'm going to kill this deal no matter what it looks like? Bruce.
Be honest, we're not recording.
Yeah, I know.
I can answer if you want to think about your answer.
I would love for you to answer. Thanks.
Okay. Yeah. Well, I'll
Thanks for billing me.
Wait, Bruce not having anything to say? Come on, man.
And not that there's anything wrong with folks that are out there looking and say, hey, I'm industry agnostic. That's okay. You can be industry agnostic. My opinion is that the customers of mine that I've seen be the most successful post acquisition, and the ones that I can really pound the table for are the people that come to me and like, I want to buy this business. Whatever it is, whether it's a stamping company or a tool and die maker or a landscaping business or whatever it is, I like to finance people that really love what they're doing and say, this is the business for me and this is why. And because when we go to credit committee, we spend more time discussing the buyer fit, how their skills are transferable to running the business. And somebody that is really passionate about what they're buying, what I have seen in our portfolio is those are the most successful searchers and the ones that I say, yeah, this is going to be one that I'm going to pound the table for and is going to be an easy one to get approved. So that's how I'd answer it.
So, I'm okay with the industry agnostic stuff. I'm completely okay with that. It's but to your point, it's how you prepare yourself for it and how the research you've put into it. I think our folks that are most successful is they really understand how the sales process works. Because you're learning about an industry you know nothing about in the most cases. So like really understanding what the seller does in that company, understanding how the sales actually are generated. Who does what? Because I guarantee you sales are not automatic. Some people are doing some things to in the company to make those sales generate. So really understanding who's doing what in the company, understanding what the seller's role is, and then that kind of complementary skill set overlay. The times where I think that some of our folks struggle is with this investment thesis that I'm just going to put technology on it. I'm going to buy I don't pick an industry and I'm just going to put some kind of technology.
The fax machine business.
Yeah. Or like, or I'm going to Google it. I'm going to put it on Google thing or something. And I'm going to put tech on it. It's like these companies, it doesn't work that way. And those are the folks I think that struggle, that think that the sales are just going to come in like they always have. And then I'm going to grow it immediately. And I just think that that's a little naive. So get a little bit more real about how difficult it is to just transition the company, just transition it, and then start growing it.
I think what was giving me pause in the question is, a good searcher versus a bad searcher. And I heard the word bad searcher, and that's what was giving me pause. I don't think I've really had bad searchers. That's why. So, for me, it's obviously about their background, their schooling, their experience, and what they can do with the business. I pay very close attention to the business plan that I get. I think that is, if you don't spend time on the business to understand that business, to understand what you're going to do with the business, it's amazing if I ask somebody to give me projections and it's just, they give me a 5-year projection and it's just like this. It's just, I own my own business for 13 years. So I've been on that side of the table and I joke about it and I say, do you think for 13 years that it did nothing but this? That doesn't happen, right? So it goes like this and maybe up and down. So for me, I put a ton of emphasis on what you tell me you are going to do with the business, how you are going to make that business your own, because I am a forward-thinking lender. You could bring me a sim and said, this business did $3 million in EBITDA 2 years ago. If I lend to the wrong person, 6 months from now, it's not going to matter that the business did $3 million in EBITDA, right? So I really don't have, it's hard to quantify that and say searchers that haven't worked out. I'm thrilled when somebody says, tell me about your portfolio, Bruce. How does it look? Tell me about the success of your searchers. They're doing awesome. I had a searcher literally, I know this is off-wind a little bit, called me up 2 weeks ago and he said, Bruce, I just wanted to reach out. I bought this business back in June of last year. Just wanted to call and say thank you again for supporting me and believing me. This has been phenomenal. I've grown the business. And by the way, how is the rest of your portfolio doing? Is it similar? And I said, yes. All my borrowers are like you. You're doing well? Yes. It's so meaningful to make sure that you're lending to the right folks. So that was the pause in the question. Because for me, it's more about what skill set you have, what you're going to do with the business, how you're going to make it your own, how you're going to grow it. And if you can't convince yourself by providing a really good business plan that outlines that to me, then it's not, if that makes sense.
I thought maybe you were pausing because your example was someone in the crowd and you didn't wanted to kind of dance around it.
Well, I have a couple of clients in the crowd and I'm thrilled that they're my clients.
Okay,
right,
let's do Q. We've got 15. Sam gave us a bonus 15 minutes here. I think it's 13 now. Let's open up to Q&A. Tough questions only. Oh, Bruce, you had a good thought on this. The rollover equity is what you're referring to. SBA is changing the regulations. Up till this point, you had to buy 100% of a business and seller had to go away. He could consult for 12 months, but he couldn't be an employee, has to go away. SBA is in the process of changing those rules. We don't have the final guidance, but suffice it to say, partial ownership will be allowed. Bruce, you had an interesting theory on this, and I'd love for you to share it with the crowd about the impact
you
it
remind
could
me?
have.
Because I don't.
Well, you have a lot of interesting theories, but this one in particular was about the impact it could have on employees and their ability to acquire these businesses now in lieu of our friends here in the crowd.
Yeah. So, when we get, a partner buyout or you have a seller, I called Eric and just talked to him about, sellers now who wanted to put their business, on the marketplace for sale. Now, can they go to their employees and say, I would love to give you the opportunity to buy this business and own it. You've been working here for 10 years. I know you haven't accumulated a lot because I haven't paid you a lot. But but I think you would be the perfect person to take over this business. I'll roll the equity, you buy the business. Does that take away potential deals in the marketplace? Was kind of just my thought. And it was just a off the market thought. The standard answer that I have been instructed to give is the SBA 5010 6.1 is not yet out in writing. And once it is out in writing, that's when we will actually be able to interpret it, deliver what we think the SBA means, because every lender interprets the SOP differently, and then we'll be able to provide guidance. And Lisa,
Lisa, what do you think of Bruce's theory?
Yeah, I mean, that could be from a lender risk perspective, lending to someone that's in the company that knows it and who's probably actually doing the work. I mean, it's probably the least risky loan that we can make. So that's an interesting idea. It depends on if they're rolling, how much they're rolling. They're still going to need cash in their pocket.
Yep.
So that may or may not be an interesting vehicle. I'm just thinking that because the employees don't have enough cash generally, that it might work in some cases pretty well, but I don't think it's going to take any deals out of your pockets whatsoever. I think generally, especially in kind of more blue collar companies, the employees just don't have the cash, and I don't think the seller's going to roll out without having some significant amount of dollars in their pocket cash. So I think there's plenty for everybody. It might help the really, really small businesses that Clint was talking about, the really small ones that probably aren't sellable. That might help in that case.
Yeah.
I think we really need to see what the details of this are before we get. I mean, I think it's a great thought, and that certainly is something that could happen. It's just such an unknown, and it's going to be out soon, and then we'll be able to speak to that a lot more.
For our conventional transactions we do for our traditionally funded searchers, roll is just it's in every single transaction. So I think as long as it's not abused, I think that it could be a really boon to making really good structured deals.
This is Costa. Lisa's actually my lender, but I'm curious, this is like off the record conversation, obviously. When things go sideways, can you kind of give a frank discussion of the restructuring process, how your internal banks have, do you move it to a different credit team? Do you have restructuring officers in-house? There's some weird incentives in place, and I think everybody here loves SBA debt. The one thing we all hate is the PG. Can you kind of talk us through the real risk profile of what we're doing?
I'm glad to say no, but I'll defer to somebody else.
Well, I was just going to disclaimer and say that I'm not an attorney, and you might want to have Eric or Kevin answer that question. We do have people in house. Every situation is different. I mean, when you get in a workout situation, there's no one size fits all for how that's going to play out. So I don't know that I'd be comfortable just speculating on kind of how that's going to go with the PG. I mean, it just depends on so many things. Is there collateral in the business? What does your personal financial situation look like? Is the business salvageable if you were to put the loan on interest only for a period of time, or are you just kind of plugging a sinking ship? I mean, there's just so many things, and every deal is different. So I don't think I would want to say more than that, and not, on the record, off the record. It's just, I don't think I could give any guidance that would be helpful.
There's a definite process, and maybe I'm the only lender that's going to actually say some of our clients struggle. They do. Some of our clients are struggling in discretionary spend categories, and just because you're struggling doesn't mean you're going to automatically go into default. But some of our CEOs are struggling. We have got 2 CEOs in industries that seem recessionary proof, and they are being hit with some softening in that kind of discretionary spend. We've got 2 situations where we had fraudulent sellers. So sometimes it's not even the fault of a bad operator. It could be a bad seller. And there are definitely different departments. So you want to stay in constant contact with your lender. If you do start to struggle, if your cash is king, if your cash starts to dry up, and you can see that your revenue cycle is starting to get funky on you and your cash is drying up, you talk to your lender immediately. Even if you think it's coming, maybe a key customer left, and customer concentrations can just bite you in the butt. And if you're the ladies, it's going to tit punch you. Matt, we got to be equal opportunity over here. Tit punch. It could tit punch you. So talk to your lender. So don't be shy. Talk to your lender. And then there are other departments. And the last thing we want you to do is file bankruptcy. It doesn't help anyone. It doesn't help you. You file bankruptcy, we cannot help you. There are clients in SBA portfolios that take years to pay their loan back. They finally pay it back. So long story short, talk to your lender if you are struggling or you think that you might potentially be fixing to think about struggling, call your lender.
And I'd just say two things, if I could, on that, because we certainly see deals. The first president that I ever worked for told me that if you're a lender that says they've never made a bad loan, you're not making enough loans. So we've all done it. And what we found when we do an analysis of the portfolio is that when we miss, it's usually one of two things. It's the seller pulled the wool over all of our eyes and nobody caught it. Q of E didn't catch it. We didn't catch it. Attorneys didn't catch it. And a searcher, a very successful searcher customer of mine told me once after the fact, you're buying the seller as much as you're buying the seller's business. And if you think that there's something not right as you're going through the purchase process, the best advice I could give you is probably run, because it doesn't get any better when you give them 90% of their money at closing. So that would be, and then the other thing is, which has been talked about a little bit, where we see when we miss is we bought into a buyer that just was not prepared to run the business, and then the buyer gets in and they kind of have like an oh shit moment. I have no idea what I'm doing, and employees are walking out the door, and I don't know how to get on one of these machines and run it. So those are kind of if those war stories kind of, so to speak, are helpful, that's some things we've seen and kind of lessons learned.
Well, I think I always tell my clients it's a real risk, right? But Byline Bank does not want your house. Byline Bank does not know what to do with your house. Byline Bank's incentives are aligned with yours. It's so circumstance dependent, and it could be very bad, or it could be a default that's not as bad as you would imagine in two dimensions. Last question, and let's make our answers quick because I think everybody's ready for lunch.
Thanks, guys. So I'm Derek Turner. I'm from Arizona, did a traditional search, and then recently did an SBA financed acquisition. I'm curious about, as I look to other acquisitions to make in the future, I've got 3.7 in a 7A loan. The easiest way to make a deal pencil is by using SBA debt. How do I think through, when I want to buy the next business, refinancing, being able to reopen that $5 million SBA cap to be able to use it for the next acquisition? What does that landscape look like? What tools are available to me when I think through the next acquisition, when I still have an SBA 7A balance, but I want to be able to tap into that $5 million cap again?
So you've used 3.7, all of us up here, do pari passu. So if you came and you said, hey, I'm buying another $4 million business, we could handle that because of the additional exposure that we would have, plus the pari passu piece. So, for us, we go up to $7.5 million in total debt. So, we could potentially look at a second acquisition for you. You typically go back to the lender that you made your first loan with and provide them the opportunity. And if they can't help you, then you reach out to another lender. But I think a strategy for several searchers who have done it, who I have worked with, when you buy the business, you want to, in my opinion, the SBA loan is to get you over the hump, right? You buy the business. But it's important for you to select what I think is a middle market lender on a conventional basis that might be able to take you out of that, and then maybe open up that SBA option as well. So you've got two options there. And once you build your business and you're past a certain EBITDA space, you are middle market anyway. Like in Clint's slide over that 10 million, where you're going to get an enterprise value, you should be in with a middle market lender.
Yeah, and I'll just put some numbers around that for Live Oak, and each lender is going to have their different thresholds. But for us to do conventional, that's a 3.5 million of EBITDA and above. So you might have to kind of catapult yourself combined EBITDA. Keep in mind too the idea that of refinancing out your SBA and doing it conventionally to free up your SBA. That 10-year money on the SBA loan sure gets you a lot of debt serviceability. And then usually why it doesn't necessarily work then to just refinance it conventionally, because now you're to a 5 or a 7-year amortization, and so sometimes those dollars don't work until you're a couple turns higher of EBITDA. As a combined companies. And then to Bruce's point, then you get into that conventional lane.
I'd echo both of their comments.
Okay. Well, I think that's it for the lenders. Bruce, Matt, Lisa, thanks for
Thanks for having us.
Yeah, thanks for having us.